Okay, thank you all for joining us this afternoon and for joining us on time. We appreciate you coming to participate in this webinar series. My name is Nyambura Ngumba and I work for InVhestia Africa. And I will introduce to you InVhestia just in case you haven't interacted with us in the past. So InVhestia is a project and corporate finance advisory firm, and our services include project and corporate finance advisory, and this includes services ranging from due diligence assignments to valuations, mergers and acquisitions, and as well in the project finance space pertaining to energy and real estate. We also carry out financial modeling, and this is building the models and auditing them, as well as training. And the competition grew out of our training function. We do this in class as well as online. We have a platform. Third, we do capital raising for entrepreneurs and businesses, as well as for projects. A lot of work done in energy I had mentioned, especially renewable energy. And lastly, we recently, maybe 2 years ago, went into public sector modeling. And from this, we have worked with the government of Kenya and the government of Zambia in developing financial models to inform key decisions, some of them being like, and one of the ones we worked on pertaining to the mining fiscal regime. And so we're glad to be offering all these different services, and some of the clients that we have worked on or worked with. Here you will see them momentarily. And these are some of the sectors that we have worked in. Of course, some of these are for training as well as for the advisory assignments. I hope you can recognize some of the brands represented there. I should also mention that we are a member of PFAN, and PFAN is the Private Financing Advisory Network, which is a project of UNIDO and REAP. They typically will deal with entrepreneurs who are looking to solve climate change, and so basically in the renewable energy space, and we're very proud to be members there. We are also members of the East Africa Private Equity and Venture Capital Association, and we have actually carried out quite a number of trainings for them, and we're pleased to be doing this work. Now I will go into the competition. The competition is in its 5th year, and we're very excited about that. Over the last 4 years, we've been in 12 universities, mostly Nairobi-based universities, and we've trained over 2,000 students. Some of these we've met face-to-face, and I can see some of you here, and others only through the platform. But this year, we're excited to be only online. While we will not meet you face-to-face, and that's the disadvantage, the great advantage is we've been able to open up the competition to students across Africa. And we're really excited. I see some people here from Uganda, from Kampala. We also have some universities, some people from Lagos, and we're really excited that you will be joining the competition this year. We started it to make an impact in the finance space, but also to develop the pool of talent that is coming in out of the universities. Now, over the years, we've had several partners, and for those of you who have participated in the past, because I see some people here also from last year, we've dealt with Aspen Network of Development Entrepreneurs, Consonance Investment Managers, EAVCA, which I mentioned we are members of, CREDEV also, and actually last week we hosted the Managing Director, Sarangamau. So if you missed that, I would encourage you please to go to our YouTube channel and catch up on what she had to say about, you know, their portfolio, how they're dealing with COVID-19, and the importance of financial modeling. Some of our top winners have also worked with Open Oil, with KPMG, Horizons Africa. So We are pleased this year as well to have 4 sponsors. The first being the Fast Standard Organization. They are the body that is responsible for promoting standardization, and so they will be giving free FAST certification tests, and the test is usually around £195. So the top students will be able to sit for the test and get certified at no cost. We're also sponsored by F1 F9, which is a financial modeling house based in the UK. They will also be sharing some of their training with the top students. EAVCA is our continued partner. This is the 3rd year we've had them on board. They will be sharing the top students' profiles with their membership across the private equity space. And lastly, but most importantly, we have Aecon, who we're really excited to have on board this year. And the top student will be getting an internship with Aecon. I should mention as well, next week on Friday, we will be hosting the rates implementation specialist from Aecon. So he will be telling you all a little bit more about the internship, and you can also hear more about what Aecon does, what they've done in the past, and the importance of financial modeling for them. Now I can see, based on the universities represented here, I see some guys from Strathmore, I see some people from UON, I see some people who are already in the workspace, Karibuni sana. Now, these are the universities that we've been to in the past and we've partnered with. Last year, we were really excited to have the Osho College joining us for the first time. And we also, I see some MKU people represented here. I think my screen has frozen. But yeah, these are some of the campuses that we have worked with in the past. And you will also see some pictures thereafter of the live sessions we typically have. So this year, I guess we cannot be taking any of those selfies with our social distancing and the way life is set up. However, we are still excited to bring this training to you. And with that brief introduction, I think you can see the speaker in some of these pictures. But I'd like to hand this over to our trainer for today. Our trainer is Kevin Mbugua, and maybe some of you, based on who I'm seeing here, have met him before. And so Kevin, karibu sana. I invite you to take it away, take it from here.
Thank you so much, Nyambura. It's a pleasure to be here to conduct this session. Karibuni sana. My name is Kevin Mbugua. I have 4 years of experience working with InVhestia, and my role is basically a financial analyst, and my every day-to-day role is creating financial models, analyzing those models, and interpreting those models to clients for them to make decisions for whatever purpose it is, be it fundraise, be it selling stake and all that. So the training today will be on an introduction to financial modeling, which is what I'll be taking you through. And our $1 million question here is, what is a financial model and what is financial modeling? So financial modeling basically involves simulating a real-world financial situation, and a financial model can be defined as a tool commonly built in Microsoft Excel that forecasts businesses or projects' performance over a certain period of time. Models can also be built on other platforms. However, most financial modelers use Microsoft Excel because it's a plain canvas. You can do just about anything you would like to do with Excel. So it brings about applications that are used to create financial models. So, and financial models are basically built for the purposes of decision, for both internal and external decisions, of course. And some of the common decisions that investors, business owners, management need to make are, should we raise capital? Do we have adequate capital? If we don't have, how much capital should we raise? What's our budget over the next 5 years? If you're working on a strategy for like a 5-year strategy, then what's our financial plan over that 5 years that implements this strategy? Should we conduct this merger, or should we acquire this particular business, or should we sell stake in our business? If so, how much should we sell stake of our business? Those are some of the common decisions that most business owners, investors, and executives of businesses have to tackle with each and every day. And models are the common tool that we use to do this. Common developers and users of financial models include one, we have financial advisory firms like InVhestia Africa. Other users are investment banks and commercial banks. We have private equity funds, which includes venture capital associations and investment funds. And we also have portfolio managers. Portfolio managers, like practical examples in Kenya are like ICA, Lion, for example. And all those, for example, insurance companies, they normally use financial models to then make decisions on how to allocate financing to the different investments so that they can be able to provide good returns to their pensioners, for example. So that's basically what a financial model is, and also the users of financial models. So the next thing is, how do we create financial models? What's the process that is involved when you're creating a financial model? So, and I'll demonstrate this using what we call a business analysis cycle. And this is the day-to-day life of a financial modeler. That on one side, we have the real world, and on the other side, you have a model world, right? And this financial modeler then comes in and tries to make or help make real world decisions by simulating performance of businesses and projects. And they simulate this in the model world. So the first thing modelers will come in and do is first understand the business situation. Let's take an example. For students, you would like to, say, open up a photocopy business, right? So the first thing that comes in is, how much money should I raise? Will it be profitable? How do I price to be profitable? What are my costs? And all that. So when it comes to then a financial modeler, when you brought such a problem, the first thing you need to understand is the operations of the business. So business situation. And you can't build a model without, you need to have what we call a top-down approach in understanding business problems and how to solve those problems by using financial models. So once you understand the problem, the business problem, you then embark onto understanding that business situation, the operations of this particular business. And when it comes to understanding the operations of this particular business, we use what we commonly call a conceptual model. And a conceptual model, I'll demonstrate it using a blueprint. So whenever a construction company embarks onto building, say for example, a hostel or a piece of property, they have to first engage an architect. This architect will come in and draw up a plan or the architectural drawings on how this particular building will look like. Yeah. Without this, what may end up happening is that this construction company will come in, probably build a small house, probably build the kitchen next to, the bathroom, or the kitchen next to the bedroom. Yeah, because they haven't clearly mapped how this particular house looks like. And that's the same thing we have with financial modeling. When you embark onto Excel without creating a conceptual model, you may end up in a situation where your model doesn't really work out. Things don't fit simply because you didn't have a clear plan or didn't fully understand the business and the intricacies of the business. And that's why the conceptual model is important. So a conceptual model can be defined as, flow diagrams or a mind map, where you try and address questions where, say, for example, here is a conceptual model, and take an example of gross profit. You want to figure out what's our gross profit. Yeah, let's go back to our photocopy business. So you want to determine your gross profit for this photocopy business that you'd like to start. So the trick here when building a conceptual model is ask questions until you can't ask anymore, right? So ask, how do I attain my gross profit? Gross profit is a factor of revenue and costs. Then go and ask yourself, how do we attain this revenue? Then you know that this revenue is attained by determining our price and how much we will sell. So what's our volume? When it comes to costs, we know that costs are a factor of fixed cost and variable costs. With an example of a photocopy business, you want to say maybe our unit price is 5 Kenya shillings to sell a printout, right? And you think that based on current demand, you can be able to sell 100 printouts in a month, right? So already you can tell that to determine your gross profit, you can already figure out, what's your revenue, right? And this will be a factor of your price, which is 5 shillings, by your volumes, which is 100 printouts, which is 500 shillings, right? And the other element is, how our costs, how do we get our costs? And we know that costs are a factor of 1, variable cost, and 2, fixed cost. And on variable cost, we already know that to determine our variable cost, we need the volume. And our volume is, how many printouts we are doing in a month. So we have printouts. What's our unit cost per printout? Perhaps our unit cost per printout is 1 shilling, right? So our variable cost is 100 shillings. Then our fixed cost. This could be 1, rent, 2, labor, 3, utilities, and so on and so forth. So say, for example, our rent, utilities, and all that come to 1,000 shillings. It means that our total cost adds up to 1,100 shillings, right? So if our total cost is 1,100 shillings and our revenue is 500, we're already in a situation where our gross profit is at a negative, yeah? And that's where building a conceptual model really comes in place. Because when you ask yourself, what's my gross profit? You can't really be able to map, you can't really be able to tell what's my gross profit until you have figured out the very unit costs and the very unit variables that come into determining our gross profit. And the same applies to every other business situation. No matter how complex it is, you could be trying to figure out what's the IRR or what's the funding need of a particular business. You embark on a similar journey of trying to figure out, what are our unit variables that come into play, and what are ingredients that we need to factor in to be able to achieve that particular IRR. So that's basically what a conceptual model is. It's a blueprint, and you can't embark on engineering anything, be it a construction or be it a financial model, without first building a conceptual model. Once you have your conceptual model, you then put it on paper, right? So you open Excel, and based on how you build your conceptual model, start building your financial model. And the step-by-step process on how to build your financial model is in fact in our course. If you go to learn.investia.com, you'll be able to access our free course as well as our other courses, and those clearly show you how to build a financial model, how to address your revenues, how to address your costs, how to address your fixed assets, how to address your capital and all that. So I'd encourage you to go to learn.investia.com to learn the step-by-step process on building a financial model. So once we've built our model, we go to our next step, which is to analyze this particular model. And one way to analyze this particular model is first, determine our base assumptions, assumptions that are sensible. For example, perhaps 100, when you go back to a photocopying business, perhaps 100 printouts per month is too little. For example, when you take a university, perhaps maybe a class will have maybe 100 students. If you have 20 classes with 100 students, then your potential demand is much more than what you had initially assumed, right? And here we are coming into our model insights. We are now coming to the realization that our base assumptions need to make sense. They need to be reasonable. And if in this school we have a demand of 2,000 units, then 2,000 printouts per month, then it means that we need to change our assumptions, right? Or we need to figure something else out. When you look at our cost side, we note that perhaps maybe these costs are reasonable, or maybe these costs are too little, right? And this is where you start getting your model insights. And once you have these model insights, you will conduct both scenario and sensitivity analysis to make sure that this model actually makes sense. And once it does, you start interpreting these model insights. Maybe in the model, it shows that, our gross profit is negative, right? And from this negative, you know that, one, we need to address maybe price. Two, you need to address volumes. And this is what we're now calling management insights. Things that someone in a real world situation, someone who's not a financial modeler, can be able to understand. That any layman, if you tell them that, our price is too low, they understand that. But when you tell them that, we have negative gross profit, then they'll ask you, okay, what does that mean, right? And that's the thing with financial modeling. You need to have an understanding of, being able to interpret what this model brings out and interpret it for someone to be able to make a decision. And for then this person to be able to make a decision, you will require to create your model in a way that it is robust enough that you can be able to change the different aspects of this model. You can be able to change our price. You can be able to change our price for photocopy business from 5 shillings to perhaps 10 shillings. You can be able to change the volume comfortably and easily, that this person can, that the decision maker can be able to make the decision in a in a fast way before that opportunity passes them, before maybe someone else comes in and sets up this photocopy business in the target location, right? And this is what a financial modeler really does each and every day. So with that, I think we have a slight understanding of what is a financial model and how you go about building a financial model, and even the intricacies of interacting between the real world and the model world, where you have insights from a model and you need to interpret these insights in a way that a decision maker can be able to make a correct decision. So next, we're going to look at a survey, and this survey was conducted in 2019 by an organization called Model Of. And Model Of is a community of professionals and students who are passionate about financial modeling. And fun fact, Model Of normally conducts annual financial modeling training for professionals, which gives financial modelers a lot of experience, when it comes to the different challenges that you may face. So it's a global competition that's quite interesting. I'd encourage you to go check out Model Of if you're interested in financial modeling. So Model Of conducted this survey and they had about 700 respondents. Some interesting things to note from this survey was that only 14% of these respondents were female, which means that the profession has an underrepresentation of women, and that's something we'd like to correct. That's something we'd like to work on. Another thing to also note is that of the respondents, 53% indicated that they work on more than one field, meaning that most of financial modelers work on either project finance models, corporate finance models, financial analysis and planning models, aspects. Yeah, and that is the same case even with us at InVhestia, because we always end up being in situations where we build different financial models for different industries. So the key aspects that I'd like to pick out from that survey are: one, a lot of financial modelers consider financial modeling as a profession, with 85% of these respondents indicating that their modeling skills have enhanced their career prospects. And a further 87% of modelers believe that the work they produce is highly valued by their clients and other external parties that come across their work. Another thing to also note is a lot of financial modelers lack formal training. And from this survey, 57% of the respondents indicated that they were self-taught. And that's something that we face each and every day, that most financial modelers are self-trained and haven't really attended any formal training. And that brings out a challenge for us. And that challenge is when it comes to standards. Because when you learn financial modeling on your own, you don't really end up having a sort of uniform way to build your models. And that's something that many modelers face, that you can't be able to build a model that somebody else will pick up and continue from where you left off. And that's where the standards is important. From the survey, 91% of the respondents indicated that they believe that standards are important. However, despite that strong support, only about 45% actually use financial modeling standards in their teams. So you have a situation where people think that financial modeling standards are important in modeling. However, not all modeling teams, or not a significant portion of modeling teams, build models based on a standard. And that creates a significant challenge for us. That's where, as InVhestia, we chose to work with the standard, and we apply an internationally recognized standard. It's called the FAST standard, and FAST is an acronym which stands for flexible, appropriate, structured, and transparent. These acronyms define what a financial model is, a FAST compliant financial model is. And one, flexible, means that, that this model can be able to meet its objectives, it can be maintained, and multiple users can be able to work on it, run scenarios, run sensitivities, make changes to this model over time, and even make adjustments once information has been availed. And this process should be fast enough. So flexibility is an important aspect in financial modeling. The other bit, appropriate basically means that that model needs to reflect key business assumptions without being cluttered with unnecessary detail. That you can be able to pick out the important aspects of this business without that unnecessary detail. And one thing to note is that a model is not the reality. It is just a representation of the reality. And that's something you need to keep in mind, that you do not require to show an exact situation of how a business runs. You just need to demonstrate a replica of how a business runs. So the third aspect, which is structured, basically means that you need to build your model in a consistent way. You need to apply a consistent layout and organization of your worksheets, your calculations, your formulas, and all that good stuff. That it's easy for someone to build a model. It's also easy for someone else to learn that model, and it's easy for people to maintain that particular model. That's structured. The other aspect, transparent, basically means that this model needs to be simple enough that it does not have significant complexities, that your formulas, your calculations, your calculation blocks are clear enough and easily understood by someone without experience in financial modeling. And even someone with financial modeling expertise can be able to pick your model and work with it. That's what transparent means. And something else to also note is that there is a trade-off between flexibility and transparency that you need to be aware of. That flexibility, when you need to have a flexible model, it means that certain complexities need to come in to have a flexible enough model. But once you have complexities in your computations, for example, that model may not be understood by people who are not experts in financial modeling, which means you're basically sacrificing transparency. And that's where the challenge comes in. You need to have a perfect balance between flexibility and transparency. So the first standard is basically a set of rules. It's to us financial modelers what IFRS is to accountants and auditors, right? And some of these rules cover aspects on sheet layout. For example, you need to color code your sheets, that each sheet has a different purpose and it's color coded based on that particular purpose. You also need to have an order for your sheets. These sheets need to be ordered starting with assumptions, next calculations, and finally outputs. Yeah. Then you also need to have rules with regards to column structure, that each column serves a specific purpose. That each column, for example, certain columns are for headers, other columns are for labels, and other columns are for computations. Yeah. And on assumptions, there are quite a number of rules that come into assumptions. And one of them is that you need to create an assumptions sheet, that your assumptions are not put where your computations are. You need to set up a different sheet for your assumptions. And it's sometimes useful to copy these assumptions to near to where you are using them in calculations. However, once you're done doing this, you need to make sure that all of your assumptions sit in one sheet, in an assumptions sheet. There are other rules regarding formula construction, and one of them is that your formulas need to be consistent across columns. Normally, when you're building financial models, you build them from left to right and top down. So whenever you have a formula and you need to copy it across. And this formula that should not change in a different column, as long as it's the same formula. You're supposed to only use one formula per time-based rule. The other rule is that you need to divide complex calculations and break them into simple steps, right? And an example is when you're computing your revenue, maybe you don't have price. You need to compute price, and you also need to compute your volume. So you need to split your revenue computation such that one computation is determining your price and another computation is determining your volumes. Then bring these two ingredients, price and volume, to compute your revenue. Another rule is that you need to have calculation blocks, and calculation blocks are basically you bringing in all ingredients for a certain computation. The same example, revenue equals to price times quantity. So you need to bring in your ingredient of price and your ingredient of quantity to where you're computing your revenue. And that's what we call a calculation block. So I'll demonstrate for you, and I'll show you a sample financial model. So I'll jump onto Excel. So what you can now see is a financial model, a sample financial model. And this model, we picked it out from our training. When you go to learn.investia.com, our introductory course and our corporate finance course covers this particular model. So it's nothing new, and it's something that you may have come across once you went through our introductory course. So to demonstrate the practicality of the first rules, as we mentioned, one, with regards to sheet layout, we have a workbook here and it has different sheets. So every time you want to, say, for example, compute revenue, you need to create a different sheet for it. It has its own specific purpose. You want to come in and compute your costs on that revenue sheet, right? And what we have here is a sample, and it starts with a cover page. And this cover page highlights the product, the author, the objective of this particular model, the version, how the last time it was reviewed, even the client. It also has a table of contents that shows the number of worksheets and defines each worksheet. Additionally, there's a key down there which highlights how cells are formatted. And an example is, one, inputs. Inputs are formatted in a light yellow, and incomplete aspects are highlighted in a deeper yellow that indicates markers, and so on and so forth. So when you look at the cover page, it's a presentation sheet, and we mark it in blue. The input IMPC sheet is basically an input constant sheet, and here we paste our constant inputs that do not change based on time. They remain constant. We put all those assumptions here, called input series. In this sheet, we paste our assumptions that are time-based, that change over a time period. And a demonstration here is our forecast local sales growth rate, that you can see it changes between December 2009, 2010, and so on and so forth. So in our input S sheet, or input series sheet, we paste our time-based assumptions. Then we have our FinStat actual. FinStat is basically financial statements, actuals. So these are our actual financial statements. Perhaps we pick this up from audited statements of this particular business. Then we have our operating revenue sheet. So input C, input S, and FinStat Act are input sheets, and we have color-coded them in a light yellow color. Then we have OpRev, which is operating revenue. We have time, which are highlighted in gray, which means they are calculation sheets. Then we have FinStat, which is an output sheet where we paste our forecasted outputs. Then we also have an additional sheet called temp sheet, which is a template sheet. As you can see, it's in a deep yellow color, which means it's temporary, it's incomplete. And this temp sheet, it's a template. So whenever we want to create a new worksheet, say for example, to cover costs, we will copy and paste this particular worksheet and use it as a template because it has specific formatting that complies to the FAST standard. So further rules of the FAST standard include one, calculation blocks when you come to formula construction. And I'll take this section, what I have highlighted, as a sample of a calculation block. We want to compute our forecast local sales. So we'll bring in our local sales and our growth rate, as well as our flags, into this particular calculation. So whenever we are computing, we're not picking things from different cells and even from different worksheets. We bring in all our ingredients to create this particular calculation block. As you can see, an example of what I have highlighted, it's the formatting here is in a blue font. And this is what we call an import. When you go into the cell, and I'm reading this from the formula bar, you can see that it's picking from FinStat Act. So our local sales actuals comes from our FinStat Act. And any import, which is basically something you picked from a different worksheet and pasted it on and linked it onto this particular sheet, it's highlighted in that blue to indicate that it's an import. If it's an export, which means you're picking from this different worksheet, it's highlighted in a red font. So that's another FAST rule. Other rules include, as you can see, column structure. Each column serves a different purpose. Column A, for example, serves as our main header. So we want our model to read like a book. You have chapters that have, titles, subtitles, sub-subtitles, and so on and so forth. As you can see, column A is where we have our title, which is our sales. Then in column B, we have our subtitles, which is our local sales. Column C, we have sub-subtitles, which covers one, our historical local sales growth rate, and where we forecast our local sales. Column B serves a different purpose, which you will see once you log onto our course. And column E, as you can see, is our labeled column. Column F is a constant, where we have constants. Column G is where we label our units. And column H is for our totals. Column J is where our computations start. So these are some of the first rules that we normally apply when building financial models. I'd encourage you to go to learn.investia.com to see how we came up with this particular calculation block and how we even came up with the different worksheets and get the step-by-step guide on how to complete this particular financial model. So with that, I'd like to hand over to Nyambura to take us through the next step.
Okay, thank you so much, Kevin, and thank you, everybody. I hope you've gotten some good information and that now everybody has a clear introduction to financial modeling and what it can be used to do. Now, I would say I noticed there's still no questions in the chat box. So if you do have any questions, now is the time. So please do put those in the chat box. And as I wait for some of those to come through, I'll just remind you the details of the competition. So the competition will be live starting the 26th of October, with the deadline for submission being 30th October. So you will have those 5 days to model out a case study that will be available and accessible for download on our learning platform. And that's learn.investia.com. Now, I had mentioned, and I think if you saw the flyer, we are going to be giving a limited amount of time on our full paid course for the people who are in this room. And we're really excited about that. I hope you all are as well. So if you have a piece of paper close to you, I think we would like you to take this down because the instructions are completely important in order for you to get the access. So first and foremost, it would require that you are already on FM 100. So if you have not yet registered for the free course, you would need to do so in order to access the full course. So what we will require you to do is send an email to learn@investia.com. And our colleague Joyce will be putting that in the chat box now, the email address that you will need to send to. Please ensure you are sending us the email using the email address that you have used to sign up on the platform. So usually to access the course, you will need an email address to register. That email address is the one that we would need you to send the email from. Now, after you open your email and create a new message, in that new message, we will require you to put in the body of the email a keyboard shortcut. Now, you will need to have done FM 100 or you have access to the handouts. You will go to the first macros and you will put for us the shortcut for shading red. Shortcut, keyboard shortcut for shading red on fast macros. I'll repeat that. Use the email address that you have signed up on the platform with to send an email to learn@investia.com. You will need to put in the body of the email the shortcut based on fast macros for shading red. We would require you to send this email before Sunday end of day. We can call it midnight. Between now and then, we will be able to grant you the access beginning of next week. So this is also to protect from the people who have not attended, but would like to take advantage of the free access. So we have also noted your attendance record here. So we will be using that as a match for the information you send. Now, I do see a question here, and let me read that out. Austin is asking, if you participated in the competition last year, do you have to create another account? And the response is no. Your account is the same account you've ever logged into the platform with. So if you have ever been on learn.investia.com, you will use the same email address that you used, the same password, and it will give you the same access. The only difference is on the platform, there will be a different folder only available starting the 26th for the competition. However, for doing the course, it's the the exact same account that you set up. Of course, we do not have access to your passwords. So this is why we are saying it's imperative. It is completely important that you use the email address that you have on the platform when you're sending the email to us, because when we grant you the access, it will be using that email address or using the account you have created with that email address. I really hope that that is clear. And then I see another question from Annie Dutta. Are the standards given under fast financial modeling open to the modeler's interpretation? Now, perhaps I can answer that based on the FAST standard organization, and then Kevin can also chip in. Now, the FAST standard is made available under the Creative Commons license. And what that means is, if you are an organization and perhaps you have your own standards, but you would still like to ascribe to the FAST standard, when it comes to matters of shading, or maybe your output sheets or your sheet layout would be different, or you would prefer for it to be different. All you need to do is say that you have used the FAST standard as a guidance. So you would need to give the copyright statement that you used the standard. So in that sense, the rules are still open for interpretation by different organizations because it is open under the Creative Commons license. However, for the competition, we will be judging based on the FAST standard as it is published now. And that document is available on our learning platform. It is available on the FAST standard website. So you can use either one of them to access the document. Kevin, do you have anything to add maybe on if standards are open to the interpretation of a modeler?
So one thing to also note is that there are FAST standard compliant templates by the FAST standard organization. And something to also that you'll also observe when you go through the standards is that based on the guidance, most of the practitioners of the FAST standard apply similar aspects to their financial modeling. So given that you have a similar template, given that the recommendations by the FAST standard are very specific, you find yourself in a situation where your interpretation of a particular rule is similar to what they're trying to communicate or what everybody else is trying to do. However, as Nyambura had mentioned, people may use different format styles as long as you ascribe to the general FAST standard, which just doesn't cover formatting. It also covers structures, It also covers, how columns look like, how worksheets work and all that. Yeah.
Thanks for that, Kevin. Jane has also shared another question. What's the difference between the input C and the input S sheet?
So input C sheet and input S sheets are both assumption sheets, right? And you find some practitioners may use one worksheet and call it assumptions. However, due to their difference in nature, we tend to separate assumptions to input C and input S sheets. Input C sheet basically means input constant, where we put our constant inputs. Our constant inputs are those inputs that do not change over time. Yeah, they don't change in whatever it will be. An example of a constant input, the days in a year, right? Or the months in a year, that's a constant input. While input S sheet, is for series-based assumptions, time-based assumptions. These are assumptions that change depending on the year. It could be that you have, say for example, different growth rates for different periods, right? So you'll put in your growth rate in the input S sheet, which is for time-based assumptions that change depending on the time period. I hope I have covered, I've been able to address.
I think you have, but what I would also maybe add and encourage you, Jane, is you see, because of you being in this meeting room, it means that you will have the access to the full course, and we're giving you access to the corporate finance and valuation course. So whatever you maybe have not gotten from this session, given how short it is, given the time that we have, you have the opportunity to go deeper into these concepts on the learning platform. So through the videos and the instruction there, you should be able to understand and even practically put together the differences between the different sheets. I see John Miner is asking, how long will we have access to the course? This are up, or possibly to the time of the competition, which I believe is 3 weeks. Sorry, which I believe is 3 weeks. So you will have access to the full course. Once the course expires, you will revert back to and learn more. I also would like to mention that we have a project finance course. So if you're looking for modeling for maybe real estate, energy, that course is better suited, and especially because it's taught using a real estate case study. So we are excited to grant you access to the valuation, the corporate finance and valuation course, and we hope that you will learn a lot from this. So given there are no other questions, I would like to maybe highlight that we still have the webinar series ongoing. We have next week the rates implementation specialist at Acorn Investment Management, Acorn Holdings Limited. And so we're excited to be hosting him. The week after that, we will be having a board member from the Fast Standard organization who will be sharing with us his experience and telling us more about the development of the Fast Standard the reason why they saw the standard to be important. So I would also encourage you to join that session on the 9th. And we will also be using the opportunity closer to the time to have a Q&A session. So we will have a live session where the whole time all we will do is answer your questions. And this can be based on the platform, and you will also hear tips from Kevin as well as other analysts on what you need to look out for to be successful at the competition. Sorry, I see Lesuda saying my network connection dropped and you didn't get the duration of the course. Now, I should mention the duration of the course is determined on how you consume it. Typically, this course lasts 3 days, but it is several videos. And if you've been on FM 100, then you have an idea of how the course is set up. However, we will only grant you access for 3 weeks. Yeah, so you have 3 weeks to do the full entirety of the course and go through all the concepts that you need to. You will learn the different valuation methods, how to run sensitivities and scenarios, several things that are not covered in the free course. So in 3 weeks, the gateway to the fully paid course will close. So I hope that is now clear. But yeah, we are really grateful for you joining this session. I think we've gone way past our time, but we do appreciate your time. Remember, we have to receive your email in order to upgrade you on the platform, so please do so. And with that, I would like to end this session. And thank you all so much for joining. The recording of this session will also be up on our YouTube channel, like the other sessions before it. So you can catch up on those even as you plan to attend the coming ones and continue to spread the word. So thank you very much and have a good evening.